Welcome to Build Your Legacy, the CRE Playbook podcast, where we break down real deals, real strategies, real opportunities, along with education in commercial real estate. We are your hosts, Alex and Sara, with Bata Commercial Group and KW Commercial, and this show is designed for investors, developers, business owners, and agents who want to build long-term wealth through commercial real estate. Let's get into today's play.
Yeah, and to start today's play, I want you to just imagine for a second taking a business to market, like a company you built entirely from the ground up.
Right, something you poured your life into.
Exactly. Say it's generating, $10 million a year in top-line revenue, and you're sitting across from a bank underwriter who looks at your financials and basically tells you the market value of your life's work is exactly zero.
God, that is just a complete nightmare scenario.
It really is, but today we are going to show you exactly how that nightmare scenario happens. We're getting into the mechanics behind why the market prices risk the way it actually does, and most importantly, how to make sure that never ever happens to you.
Yeah, it's a brutal reality check for a lot of people.
Right.
Because, it happens far more often in the private sector than anyone wants to admit, right?
All the time. The thing is, when people think about selling an asset, they are so conditioned by the public markets.
Like the stock market.
Exactly. You want to sell a block of publicly traded stock, you just, pull up a ticker on your phone, the market gives you a price down to the absolute penny based on algorithmic efficiency, you click sell, and boom, it is instantly monetized.
It's binary. It's super comforting, honestly.
Right. But valuing a privately held business is the absolute antithesis of that. It's a highly subjective, really multi-layered financial puzzle.
And that murky landscape, that confusion, is exactly why we put together this deep dive today. Because whether you are, prepping for a partner buyout, or maybe you are an agent looking to level up your commercial acquisitions knowledge.
Or honestly, even if you are just insanely curious about the actual mathematics of how private wealth changes hands.
Exactly. You are here for one fundamental reason. You want to know how to answer the ultimate question, which is, what is this business actually worth?
Which is easily the single most common and honestly perhaps the most dangerously misunderstood question any business owner or investor faces in their entire career.
Absolutely. And to really tackle this today, we have this incredible stack of source material to work through. Jack Baytal, who is our director and lead agent right here at Bata Commercial Group, he specifically curated today's market data, the transaction comps, and all these valuation models for us.
Yeah, because Jack and our whole team see owners and buyers wrestling with these exact same misconceptions every single day.
Right. So we are looking at a cross-section of recent market reports, some blinded quality of earnings audits, and internal deal postmortems. Over the next hour or so, we are just completely deconstructing the entire valuation machine.
From the really granular mechanics of SDE and EBITDA all the way to the psychological warfare of industry multiples and the strict, pretty unforgiving realities of commercial lender underwriting.
And we are anchoring all of this in reality. Like, we aren't dealing in abstract corporate finance theory today. We are applying these exact valuation mechanics directly to the Florida market.
Yeah, looking at actual real-world case studies from coastal manufacturing plants, Orlando service businesses, Tampa logistics firms, the dynamics of the Sunshine State market present some really unique valuation challenges, and we are going to dissect them.
The mission here is to essentially give you a massive shortcut so you can be the most informed person in the room during a transaction. But before we get into the heavy math, just a really quick note. If you are listening to this and realizing you need a personalized, heavily scrutinized evaluation of your own commercial operations.
Or if you're looking to acquire an asset and need representation.
Right, exactly. You can contact an agent on our team directly at www.batacommercial.com. And that is spelled B-A-T-T-A. Again, www.batacommercial.com.
So, all right, let's dismantle the most dangerous trap in business valuation first. Long before a broker ever even looks at a trailing 12-month P&L, we have to deal with the revenue myth.
Oh, the revenue vanity metric.
Yeah.
It really is the original sin of business valuation, isn't it?
It's unbelievable how common it is. I mean, a business is typically a person's largest, most illiquid financial asset. They pour decades of capital and sweat equity into it. Yet when it comes time to determine an exit price, owners routinely try to just pull a number out of the ether.
And almost universally, they anchor that number to their gross revenue.
Exactly. It's the classic country club conversation. An owner sits down at the bar and says, well, we pushed $15 million in sales last year, so the enterprise value has to be at least $15 million.
Right, or they try to benchmark it against a totally unrelated transaction. Like, let's say my buddy up in Boca Raton sold his distribution company for $8 million, and my warehouse does the exact same volume, so my absolute floor is $8 million.
Which is just a fundamental misunderstanding of what a buyer is actually purchasing. I mean, it is completely understandable why an owner fixates on top-line revenue. It's the biggest, flashiest number on the tax return.
It looks great on paper.
Right. It shows market penetration. But buyers do not buy revenue. Buyers buy cash flow, and buyers buy yield.
Let's really drill into that disconnect, because I think there is this pervasive assumption out there that if a business has massive gross receipts, the intrinsic value is just inherently there. Almost like a massive revenue stream is this, I don't know, protective moat.
Yeah, let's look at the actual unit economics of that. Imagine a heavy logistics company operating out of Miami. They are doing $10 million in annual gross sales.
Which on paper sounds like an absolute behemoth.
Right. But let's look at their operating reality. Their fleet is aging and constantly requiring really heavy capital expenditures. Their fuel costs are unhedged, so they're super volatile. Their labor costs for CDL drivers are just skyrocketing right now.
Not to mention their insurance premiums in the Florida market have probably doubled in the last few years.
Exactly. So at the end of the year, that $10 million revenue machine drops barely $100,000 in actual distributable cash flow to the bottom line.
Wow, so the margins are completely violently compressed.
Yeah, entirely. So now, put yourself in the shoes of a buyer. Are you going to pay $5 or $10 million for the absolute privilege of managing $10 million worth of operational stress, legal liability, and employee turnover just to yield $100,000 a year?
No way. That is what, like a 1% return on operational friction?
It's terrible. You could literally put your money in treasury bonds, go sit on the beach in Clearwater, and make more money with zero stress.
That reframes the entire asset. I mean, the $10 million isn't a badge of honor anymore. It's just the massive, terrifying operational footprint that's required to squeeze out a tiny little fraction of profit. I gotta think of it like a yacht versus a fishing boat.
Oh, that's a good analogy, yeah.
Like you have this massive, flashy yacht that costs a total fortune in fuel and maintenance and crew. High revenue, but incredibly low profit. Contrast that with a sturdy, highly efficient commercial fishing boat that just consistently pulls in a lucrative catch every single day. Lower revenue, but huge profit.
I love that. Let's actually look at a fishing boat example, metaphorically. Think of a leaner, highly optimized operation. Let's look at, say, a specialized commercial pool and water feature maintenance company down in Naples.
Okay, totally different industry.
Right, and they only do $2 million in gross revenue, but they have hyperdense routing logistics, meaning their trucks barely use any fuel. They have long-term commercial contracts. Their chemical supply chain is locked in at fantastic rates.
So they operate with incredible efficiency.
Exactly. And at the end of the year, they drop $600,000 in clean, reliable profit to the owner.
So wait, the $2 million business is making $600,000, while the $10 million business is only making $100,000. That $2 million business is going to command a massive premium over the logistics company.
Huge premium. It's like comparing two entirely different asset classes.
It reminds me of the Jenga tower analogy when we look at customer concentration, which I know Jack highlighted really heavily in the market data he provided us for this.
Oh yeah, customer concentration is the perfect bridge here because it illustrates exactly why top-line revenue is a total mirage if the foundation of the business is rotten. Walk us through that Jenga analogy because it is exactly how institutional buyers view risk.
Yeah, so imagine a business as a Jenga tower, right? And every single block in that tower represents a stream of revenue or a customer. If you have a highly diversified company, say a retail operation or a massive B2C service company, you have thousands of tiny little blocks.
Right, lots of small customers.
Exactly. If you pull one block out, like if you lose one single customer, the tower doesn't even shake. The business is incredibly stable. But let's say you are looking at an aerospace parts manufacturer over in Brevard County. They do phenomenal revenue. But you look closely at their accounts receivable, and you realize that 65% of their gross revenue is coming from one single defense contract.
One massive Jenga block sitting right at the absolute base of the tower.
Exactly. The top-line revenue looks gorgeous on a spreadsheet. But if that one defense contractor decides to, resource those parts to a cheaper facility in Mexico, or if the government suddenly cuts the program funding,
that massive Jenga block is just yanked right out.
And the entire tower instantly collapses. The business goes from being wildly profitable to completely insolvent overnight.
And that is the exact calculation an acquisitions team is making during their due diligence phase. They aren't looking at the past revenue and sharing, they're looking at the future revenue and searching for the fatal flaw.
They price in the risk of that block being pulled.
Exactly. If the customer concentration is that high, the perceived risk is just astronomical. A buyer simply will not pay top dollar for a company that is literally one phone call away from bankruptcy, regardless of how many millions they grossed last year.
So this really forces a complete paradigm shift for you as the listener. If we accept that top-line revenue is just vanity, and we acknowledge that the market prices assets based on the durability of the actual profit, well, we need a standardized metric to figure out what that profit actually is.
Right.
And for the vast majority of Main Street businesses, that baseline metric is SDE.
Seller's discretionary earnings. This is the absolute bedrock of valuing owner-operated businesses in the lower middle market.
Let's really deconstruct SDE. Because for the agents and investors listening who were used to looking at, net operating income or NOI on a commercial real estate pro forma, how does SDE actually differ? And what is its specific utility?
Good question. So SDE is designed to answer one very specific, highly practical question for a buyer. It asks, if I acquire this business, step into the current owner's shoes, and operate this company full time, what is the total pool of financial benefit I can expect to extract from the enterprise?
So it's a very localized, heavily operational metric.
Exactly.
Meaning, this is definitely not the valuation model you use if a massive private equity fund is buying, like, a pharmaceutical company.
Correct. SDE is the gold standard for Main Street and lower middle market businesses, typically those valued under the $1.5 to $2 million threshold. We were talking about the real economic engines of Florida here.
Like family-owned HVAC companies in Orlando.
Yes, or coastal marine construction firms, high-volume auto repair shops in Jacksonville, specialized medical practices, multi-location dry cleaners. Basically, businesses where the owner is actively involved in the day-to-day operation.
Right, and they might not necessarily be the technician turning the wrench or pouring the concrete themselves, but they are the primary operator. They are managing the foreman, holding the relationships with the key vendors, and really driving the daily strategy.
Exactly. So to calculate SDE, we do not just look at the net income line on the absolute bottom of the tax return.
Yeah, that number is usually a lie, right? Or at least a
Yeah.
highly massaged truth.
It is. Net income is a tax mitigation number. It is purposefully engineered by CPAs to be as low as legally possible to minimize the owner's tax burden at the end of the year.
Right, the CPA's entire job is to make the business look broke to the IRS. But the broker's job is to make the business look as profitable as it truly is to a potential buyer.
Which introduces the add-back process.
Huh.
We take that artificially depressed net profit figure and we meticulously reconstruct the true cash-generating power of the business by literally adding money back to the bottom line. We are normalizing the financials to reflect reality.
Let's put this into a heavy real-world case study so people can really grasp it. Let's invent a company based on the comps Jack pulled for us. We'll call it Suncoast HVC down in Central Florida.
Okay, Suncoast HVAC.
The owner, David, is ready to retire. He brings us his tax returns, and the net profit line says the business only made $20,000 last year. Now, a novice buyer looks at that and runs for the hills, obviously. Walk us through the anatomy of normalizing Suncoast HVAC's financials.
Okay, we start with the most significant add-back, which is almost always the owner's compensation. Let's say David paid himself a W-2 salary of $250,000.
Okay.
We immediately add that $250,000 back to the $20,000 net profit. Why? Because the business successfully generated that capital to the benefit of the owner, it was simply categorized as payroll expense on the taxes rather than retained earnings.
Okay, so our SDE is now sitting at $270,000. That's pretty straightforward. But this is where the commingling of personal and business lives gets incredibly muddy. What about all the expenses David runs through the business that a new owner wouldn't necessarily incur?
This is where we act as forensic accountants. We look closely at personal auto expenses. Say David runs a fully loaded Ford F-250 King Ranch lease, plus the commercial insurance and the gas, through the company to the tune of $25,000 a year.
Which happens constantly.
Constantly. But David isn't actually doing service calls, right? He sits in the office doing dispatch and strategy. A new owner could just drive a Honda Civic to the office. The business itself doesn't require the King Ranch to operate, so we add that $25,000 back.
Got it. So now we are at $295,000. What about stuff like health insurance? or retirement contributions.
Those are standard add backs. If the business pays $30,000 a year for premium health coverage for David and his entire extended family, and then maxes out a 401k match for him at another $20,000, we add those back.
Because the new owner will just structure their own benefits package out of the total SDE pool.
Precisely. We are essentially peeling away David's personal lifestyle to reveal the naked operational cash flow of the HVAC business itself.
We're also looking for non-cash expenses too, right?
Right.
Like depreciation.
Yes. Depreciation and amortization are accounting fictions, essentially. They are designed to spread the cost of an asset over its useful life for tax purposes. If Suncoast HVAC shows $80,000 in depreciation expense on their fleet of vans, we add that back because David didn't actually write an $80,000 check to a depreciation vendor last year.
Right, that cash remained in the operating account. It's just a paper loss.
Exactly.
But that changes the entire dynamic. You aren't valuing the business based on the current owner's capital structure or their personal tax strategy.
Exactly. And that brings us to interest expense, which is another big one. We add back all interest payments on the company's debt.
Wait, I actually want to challenge that because this trips up a lot of buyers. If Suncoast HVAC has a massive line of credit and they're paying $40,000 a year in interest to the bank, that is a real, literal cash expense. Like cash is leaving the building. Why on earth would we add that back and pretend it didn't happen?
Because we are valuing the enterprise, not David's personal financing choices.
Okay, explain that.
Let's say David bought out his former partner 5 years ago and took on a massive loan to do it, which generated that huge interest expense. When a new buyer acquires Suncoast HVAC, they are not taking on David's loan. They're bringing their own capital stack to the table. They might buy the company in all cash, meaning their interest expense on day one is absolutely zero, or they might use an SBA loan with a totally different interest rate. So to compare this business apples to apples against other HVAC companies, we have to make the valuation capital structure neutral. We strip out the interest to show what the core operations actually yield on their own merits.
Okay, that makes perfect sense. You're isolating the engine from the chassis, basically.
Okay, so through all these add backs, Suncoast HVAC has gone from a pathetic $20,000 net profit to an SDE over $400,000.
But here is where the tension definitely breaks out during a deal. Where is the actual boundary line on these add backs? Because if I am representing the seller, I want to classify every single expense as a one-time anomaly or a personal perk to just pump up my SDE as high as possible.
Oh, of course.
If David says, oh, that $40,000 marketing conference in Aspen, that was totally a personal vacation, add it back? How do you adjudicate that?
This is exactly why the SDE worksheet is a total battlefield during due diligence. It requires really aggressive, evidence-based mediation by a firm like Bata Commercial Group. We cannot just take the seller's narrative at face value.
You have to prove it.
The phrase we use constantly is defensible and verifiable. If David wants to add back the Aspen trip as a personal expense, the buyer's quality of earnings team is going to demand proof that no actual business was generated from that trip. If it truly was a vacation disguised as a tax write-off, sure, it gets added back.
But what about operational anomalies? Let's say David claims a $60,000 repair bill on a heavy commercial chiller was a freak, once-in-a-decade occurrence, so he wants to add it back to his SDE.
The buyer's team will pull the maintenance logs. They will look at the expected lifespan of that specific chiller model. If the data shows that chillers of that age require massive overhauls every 2 to 3 years, then that $60,000 expense is rejected as an add back.
Because it's just the cost of doing business.
Exactly. It is classified as deferred maintenance or a recurring capital expenditure. It stays in the expense column, which drives the SDE right back down.
The tension there must be incredible. You have the seller desperately trying to inflate the SDE, and the buyer's accountants acting like forensic detectives trying to drag it back down to reality.
It's high-stakes financial combat, honestly, which is why having an experienced broker who understands the microeconomics of the specific industry like HVAC in Florida is critical. You have to know what a standard P&L in that industry actually looks like to know if an add-back is legitimate or completely fabricated.
So SDE gives us the true, normalized cash flow for an owner-operator. But as a business scales, the fundamental nature of the transaction completely transforms. When a company graduates from being a local Main Street operation into a true lower middle market enterprise, SDE actually becomes obsolete.
It does, and the transition threshold usually happens when a business hits that $1.5 to $2 million valuation mark, or honestly, when its internal management structure matures. At that point, the buyer pool shifts, and we stop talking about SDE entirely, and we start underwriting based on EBITDA.
Earnings before interest, taxes, depreciation, and amortization. It's probably the most ubiquitous acronym in corporate finance. But looking closely at it, the mechanics of EBITDA are incredibly similar to SDE, right?
Right.
You start with net income, you add back taxes, you add back the non-cash depreciation and amortization, and you make a capital structure neutral by adding back the interest.
Yes.
Structurally, what is the actual dividing line between SDE and EBITDA?
The massive structural difference hinges entirely on how we treat the current owner's compensation. And that is dictated by who is sitting across the closing table. With SDE, we assumed the buyer was a wealthy individual or maybe a partnership intending to buy themselves a lucrative job.
Right.
With EBITDA, we assume the buyer is an institution, like a private equity group, a family office, or a strategic corporate acquirer.
The institutional capital allocators.
Exactly. And a private equity firm managing a $100 million fund has absolutely no intention of moving down to Orlando to run an HVAC company. They're buying the asset purely as an investment vehicle.
They aren't going to be dispatching trucks at 6 a.m.
Definitely not. Therefore, the financial model must reflect the reality that they will have to hire a full-time professional CEO or general manager to run the daily operations in David's absence.
Okay, this is the critical pivot. With SDE, we took David's $250,000 salary and added the entire thing back to the profit pool because the new owner was going to keep it.
Right.
But with EBITDA, if a private equity firm buys Suncoast HVAC, they have to physically pay someone to do David's job.
Exactly. Let's say the fair market value to hire a competent executive-level general manager for a commercial HVAC company in the current Florida market is $150,000 a year plus bonuses. When calculating EBITDA, we do not add David's entire salary back.
You only add back the difference.
We only add back the $100,000 differential. We must leave that $150,000 in the expense column to reflect the true cost of professionalized management.
So EBITDA is explicitly designed to show the yield of the asset. After all, operational management is fully compensated. It is the pure return on capital.
Precisely. Private equity firms use complex leverage buyout, or LBO, models. They use massive amounts of institutional debt to acquire these companies, and they need to know exactly how much free cash flow is available to service that debt and deliver a preferred return to their limited partners. SDE is useless to them because it artificially inflates the cash flow by ignoring the actual cost of management.
I see. But this creates a really interesting strategic dilemma for companies caught in the middle. Let's look at, say, a precision manufacturing plant in Tampa.
Okay.
They're doing about $10 million in revenue, maybe generating $1.2 million in SDE. They are right on that borderline.
Yeah.
How does an owner, or how do we at Bata, decide whether to package and market this asset to an owner-operator using SDE or to a private equity roll-up using EBITDA?
That is the transition zone, and it is where the most strategic brokerage work really happens. When we encounter an asset in that bracket, we actually underwrite and present both models simultaneously. Yeah, we build a dual-track confidential information memorandum. We basically tell the market, look, here is the SDE yield if an individual buyer wants to step in as the active CEO. And here is the adjusted EBITDA yield if a strategic buyer wants to acquire this as a bolt-on to their existing portfolio.
So you cast a wider net, but you have to tell two different financial stories depending on who is reading it.
Yes. But to be honest, the internal structure of the business often makes the decision for you pretty quickly. If the owner of that Tampa manufacturing plant works 70 hours a week, personally programs all the CNC machines, holds all the supplier relationships in his own head, and doesn't have a strong management team beneath him.
We cannot sell that business on an EBITDA multiple to private equity.
Absolutely not. Because the institutional buyer looks at it and says, there is no actual enterprise here. This is a personality cult built around one guy. If he retires, the business just evaporates.
Right. Private equity buys self-sustaining cash flow engines. If the engine stops running the moment the founder leaves the building, it isn't an investment, it's just a liability. Which perfectly transitions into the next major mechanic of the valuation machine. Because we have spent all this time isolating the true cash flow number, whether that is SDE or EBITDA. But cash flow is just an annualized income stream. How do we translate that yearly income stream into a massive lump sum enterprise value?
Right.
If Suncoast HVAC has an SDE of $500,000, David can't just demand $500,000. He demands a multiple of that number.
The multiplier. This is the fulcrum of the entire deal, and it is easily the most fiercely debated variable in commercial acquisitions. You take the normalized earnings, and you multiply it by a factor determined by the market to arrive at the enterprise value. So if the multiple is 3, David's $500,000 SDE translates to a $1.5 million valuation.
But the million-dollar question is, where does that multiplier actually come from? Because I talk to owners all the time who think there is some universal magic multiplier. Like they'll say, every service business sells for 4x. It's treated like gospel.
And it is completely false. There is no universal multiple anywhere. Multiples are a direct reflection of risk and growth potential. They are incredibly elastic. Let's examine this by looking at 2 competing commercial landscaping companies in the Orlando market, both generating the exact same EBITDA of $500,000. We'll call them Company A and Company B.
Okay, so 2 identical bottom lines on paper.
Right. Now, Company A focuses entirely on residential, month-to-month lawn maintenance in transient neighborhoods. They have a massive churn rate with their employees, basically relying on day labor. Their equipment fleet is aging, leading to super high maintenance costs. And most dangerously, the founder is the only person who actually knows how to optimize the daily routing schedules.
Okay, so the cash flow is there today, but the foundation is incredibly brittle. It's a high-friction, high-risk operation.
Exactly. A buyer looking at Company A sees operational chaos and extreme fragility. They are taking on a massive amount of risk that the $500,000 in EBITDA will shrink the very moment they take over. Because the risk is high, the market demands a rapid return on investment. The multiple shrinks. Company A might only command a 2.0 or maybe a 2.5 multiple in the open market.
Got it. Which values the enterprise at roughly $1 to $1.25 million.
Yeah.
Now, what about Company B?
Company B ignores residential work entirely. They focus exclusively on massive, multi-year commercial contracts with homeowner associations and municipal parks across Central Florida. These contracts have built-in inflation escalators. They have a solid layer of middle management account managers who handle the day-to-day client relationships.
So the owner isn't the bottleneck.
Right. Their fleet is totally under warranty, and their customer base is incredibly diversified. No single HOA represents more than 5% of their total revenue.
So no massive Jenga blocks at the bottom of the tower. The future cash flow of Company B is locked in. It's highly predictable.
Precisely. Because the cash flow is highly durable and the operational risk is heavily mitigated, institutional buyers will literally fight over this asset. They are willing to pay a heavy premium for certainty. So Company B might command a multiple of 4.5 or even 5.0.
Let's just pause and look at the math on that for a second, because both companies generate $500,000 in profit. But Company A is worth $1.25 million, and Company B is worth $2.5 million. Company B is worth double the price, strictly because of the risk profile.
It's amazing, isn't it?
A shift of just 0.25 and a multiplier on a lower middle market deal represents hundreds of thousands of dollars in equity, either gained or completely lost by the seller.
It is staggering when you look at the delta. Buyers are not just pricing the current income, they are actively pricing the durability of that income. The lower the perceived operational risk, the higher the multiple expands.
But how do we establish the baseline? Like in commercial real estate, if I am selling a multifamily property, I pull comps. I look at the cap rates of 3 other apartment buildings that sold in that exact zip code last month, and I have a relatively tight empirical data set to price my asset.
Does that level of transparency even exist for private businesses?
It is significantly more opaque, unfortunately, because businesses are dynamic, living organisms with unique legal liabilities, brand equity, and human capital, whereas an apartment building is, relatively static. However, professional brokers do not operate on gut feelings. We rely on aggregate, verified transaction data, primarily through resources like the Business Reference Guide, or BRG.
The BRG. Explain how this actually functions as a tool for our team.
So, the Business Reference Guide is an exhaustive, annually updated compendium published by Business Brokerage Press. It aggregates thousands of verified, closed transactions across hundreds of highly specific NAICS industry codes. It provides us with a statistical baseline.
Give me an example of how that works. Sure. So if we are evaluating a coastal marine construction company here in Florida, the BRG might show us that over the last 200 closed transactions nationally, this specific industry typically trades in a band between, say, 3.2 and 4.1 times EBITDA, plus the wholesale value of the heavy equipment.
So it essentially gives you the guardrails.
Yeah.
You know you aren't going to get a 7x multiple for a marine construction firm because the historical data absolutely refutes it.
Exactly. It grounds the seller's expectations in actual reality. But, and this is super crucial, the BRG is just a statistical starting line. At Bata Commercial Group, we take that baseline data and we overlay the localized macroeconomic conditions.
Right, because Florida isn't the same as Ohio.
Exactly. How is the massive population influx into Florida affecting demand for marine construction? How are the skyrocketing commercial insurance premiums compressing future margins down here?
Right. If a hurricane just wiped out half the docks on the Gulf Coast, the multiple for a marine construction firm might temporarily detach from the national average because local demand just spiked by 1,000%.
Precisely. We synthesize the raw statistical guardrails of the BRG with the messy, hyperlocal reality of the specific operation to triangulate a highly defensible asking price.
Which brings us to the ultimate reality check of this entire process. Let's say we do everything perfectly. We normalize the SDE. We build a bulletproof case for a premium 4.5 multiple because the customer concentration is low and the management team is elite.
Okay.
We find a private buyer who falls in love with the business and signs a letter of intent at our sky-high asking price. The seller is popping champagne, and then the deal completely disintegrates 45 days later.
Happens all the time.
Because they forgot about the silent, ruthless partner in the room who has the ultimate veto power over the valuation.
The commercial lender.
The lender's lens. Why is the bank the ultimate gatekeeper of business valuation?
Because the vast majority of lower middle market acquisitions are leveraged, very few buyers are liquidating millions of dollars of personal treasury bills to buy a business in all cash. They are utilizing leverage to amplify their returns. We are typically dealing with SBA 7A loans, which have specific multi-million-dollar caps, or conventional commercial financing for larger deals.
And bank underwriters are notoriously devoid of imagination or sentimentality.
Oh, they're purely quantitative. A buyer might be willing to overpay for a business because they see massive synergies or incredible future potential, but commercial lenders do not lend on potential. They do not underwrite hope. They lend strictly on historical, documented, verifiable cash flow.
They need absolute mathematical certainty that they are going to get paid back.
And the primary instrument they use to measure that certainty is the debt service coverage ratio, or DSCR.
DSCR. Now, we deal with this metric daily when underwriting commercial real estate, but its application in business acquisitions is much more complex because the operational expenses are so incredibly volatile. Break down the mechanics of the DSCR test for a business loan.
In its simplest form, the DSCR asks one unforgiving question. Does the historical SDE or EBITDA of this business generate enough cash to comfortably cover the new monthly debt obligations after accounting for all normalized operating expenses?
But the cash flow has to stretch incredibly far, right? It isn't just about making the mortgage payment on the loan.
Not at all. The bank maps out an entire cascade of obligations. First, the SDE must cover the principal and interest of the acquisition loan. Second, it must provide a reasonable living salary for the new owner. The SBA explicitly requires this.
Wait, really? The bank mandates a salary?
Yes. They do not want the new owner starving because desperate owners make catastrophic operational decisions that threaten the bank's capital.
That makes sense. The bank wants a well-fed, highly focused captain steering the ship. What else does the DSCR have to cover?
It has to cover all the working capital needs, provide a cushion for deferred maintenance or unexpected capital expenditures, and leave enough margin for minor economic downturns.
Let's run the hard math on this so listeners can see exactly how a bank kills a deal. Let's say our HVAC company has an SDE of $100,000 a year. The buyer wants to leverage the acquisition heavily, and the annual loan payment for the note is going to be $80,000 a year.
The underwriter will deny that loan instantly. The file won't even make it to committee.
But mathematically, there's $20,000 left over. The loan is technically covered.
A $20,000 margin of error on a $1 million commercial operation is effectively zero. If fuel prices spike, if one commercial chiller needs an emergency replacement, or if gross revenue dips by a mere 5%, the business is instantly cash flow negative and defaults on the note. Lenders typically demand a minimum DSCR of 1.15 to 1.25.
Meaning, for every $1 of debt obligation, the business must historically generate $1.25 of free cash flow.
Exactly. That 25-cent delta is the bank's armor against reality. So if your loan payment is $80,000, the bank requires an SDE of at least $100,000 after the new owner's salary is already accounted for.
So if I am a seller and I want to push my asking price to the absolute moon based on a crazy multiple, if the math doesn't clear the bank's DSCR hurdle, the deal is dead. Is it safe to say that a business's true maximum value is ultimately capped by what a commercial bank is willing to underwrite?
In 90% of transactions, absolutely. Unless you have a strategic buyer paying all cash or a private equity group utilizing alternative mezzanine debt, the conventional bank is the third buyer at the table. You can negotiate a $10 million enterprise value, but if the DSCR mandates that the SDE only supports a $6 million loan, the buyer can't secure the capital. The financing contingency fails and the transaction completely collapses.
Which introduces alternative structures, right? If the bank only underwrites $6 million and the agreed price is $10 million, the seller has to bridge that massive gap with seller financing, basically taking on a subordinate note, which carries immense risk for the seller if the new buyer tanks the company.
Exactly. The valuation math has to survive the brutal scrutiny of the underwriter, or the seller has to literally become the bank themselves, which completely changes their risk profile in retirement.
Which makes preparation the absolute most critical phase of this entire ecosystem. Knowing exactly how aggressive buyers, forensic accountants, and ruthless lenders are going to scrutinize an asset, we have to talk about what actionable steps an owner can take today to engineer a higher valuation.
This is honestly the most empowering realization for an owner. Valuation is not static. It is not handed down by fate. It can be systematically engineered and deliberately improved over a multi-year horizon by focusing on specific value drivers.
Let's run through the Bata Playbook for value drivers. What is the absolute foundation?
Clean, ideally reviewed or audited financial statements. I cannot overstate the psychological impact of this during due diligence. If an institutional buyer or a bank asks for your trailing 12-month P&L and you provide a convoluted QuickBooks file that commingles 3 different entities and hasn't been reconciled by a CPA in 2 years,
You instantly destroy your credibility and your multiple.
instantly, it screams systemic risk. If the owner doesn't have granular control over their own cash flow, the buyer assumes the operational foundation is equally chaotic.
Precisely. Next is consistent profitability. Buyers discount erratic performance. They want to see a predictable, sustainable upward trajectory, not a massive spike in profit, followed by a year of unexplained losses. And we talked heavily about owner dependence earlier too, the personality cult business.
Yeah, you must build an operations manual. You have to extract the institutional knowledge from the founder's brain and encode it into documented standard operating procedures. You need a layer of capable management who can run the daily operations, handle the vendor disputes, and close the sales without the owner in the room.
Because if the business cannot function while the owner is on vacation for a month, the business is highly illiquid.
Exactly.
What about the nature of the revenue itself? We know diversifying the Jenga tower is critical, but are all dollars valued equally by the market?
Absolutely not. Recurring revenue commands a massive premium. If you run a commercial landscaping company, a one-off $50,000 hardscaping project is great for cash flow today, but it holds very little enterprise value because it is non-recurring. However, a 5-year monthly maintenance contract for that exact same $50,000 is guaranteed future yield.
So buyers will push the multiple significantly higher for contracted recurring revenue because it practically eliminates the downside risk.
Yes. And on the physical side, strong lease terms are non-negotiable.
Oh, critical. If you own a high-volume restaurant in Tampa, but your lease expires in 8 months and the landlord is notoriously difficult, the business is essentially worthless to a buyer because the location is entirely at risk.
Yeah.
You absolutely must secure long-term, transferable leases with favorable options before going to market.
So the playbook is pretty clear. Audited financials, consistent margins, documented SOPs, robust management layers, diversified customers, recurring revenue models, and ironclad leases. It is incredibly logical, but sellers constantly fall into traps.
What are the most catastrophic mistakes you see owners make when they decide to sell?
The mistakes are usually born out of deal fatigue or sometimes just arrogance, but the most pervasive and destructive one we hear is, "I'll clean up my books after I find a buyer."
Oh man, that is corporate suicide. I always compare saying I'll clean up my books later to trying to pour a new concrete foundation for your house after the home inspector has already arrived and found the cracks. The damage to your credibility is permanent. The buyer immediately assumes that if the books are a mess, there are environmental liabilities, pending lawsuits, or tax evasion hiding in the shadows.
It immediately triggers a massive discount in the buyer's mind, or they simply walk away. Buyers verify everything in due diligence. They cross-reference the P&L with state tax filings, payroll records, bank statements. If the narrative doesn't match the math perfectly, the deal dies.
What are the other major pitfalls?
Well, there's my revenue's enough to justify the price, which we obviously thoroughly debunked today.
Right.
Then there's I know what it's worth because I know how much I need to retire. Let me be clear. The market does not care about your retirement goals. It cares about yield. And finally, the ultimate trap, I can just sell it myself and save the broker fee.
The DIY approach to liquidating a multi-million-dollar legacy.
It is a recipe for a nervous breakdown. Navigating the SDE add-back wars, defending your multiple against institutional buyers, managing the brutal timeline of bank underwriting, and surviving the forensic colonoscopy of due diligence, all while simultaneously trying to run your company full-time so the revenue doesn't dip, is virtually impossible for an individual owner.
Which brings us perfectly to how our team at Bata Commercial Group actually secures the bag for our clients. Because this ecosystem is so complex and adversarial, owners simply cannot navigate it in the dark. Jack Baytall and our entire business brokerage division are structured to absorb that friction and engineer the absolute maximum exit value.
Exactly. Our philosophy at Bata is proactive, not reactive. We really do not want an owner calling us when they are desperate, burned out, and demanding to sell tomorrow. We want to engage with owners years before they intend to hit the open market.
Walk the listener through that timeline. What is the actual tactical process when an owner engages our team early?
It begins with a comprehensive internal valuation and operational audit. We essentially subject the business to a mock due diligence process. We analyze their raw data, we calculate their defensible SDE and EBITDA, we scrutinize their add-backs, and we heavily benchmark their metrics against the BRG and our proprietary Florida market data.
We basically hold up the mirror so they can see exactly what a ruthless private equity buyer or bank underwriter will see long before they ever enter the room.
Precisely. We identify the fatal flaws. We might tell a number, look, your customer concentration with this one logistics firm is at 40%. Your multiple is currently capped at 2.5x. Spend the next 18 months aggressively diversifying your client base, and we can push that multiple to 4.0x before we list. We actively build the value.
And once the asset is optimized and the financial packaging is bulletproof, we transition to the marketing phase. And this is a massive differentiator in business brokerage compared to traditional commercial real estate. You do not just staple a for sale sign to the front gate of a manufacturing plant and put it on LoopNet.
Oh, never. Confidentiality is the lifeblood of a business transaction. If word leaks out prematurely that a stable company is on the market, the enterprise value can evaporate in weeks.
Let's paint that scenario. You own a thriving logistics company in Jacksonville. The rumor mill starts churning that you are looking for an exit. What actually happens on the ground?
It triggers systemic instability. First, your key executives and top-performing sales reps panic about their job security. They don't know if a corporate raider is going to buy the company and fire everyone, so they immediately start updating their resumes and defecting to your competitors.
Right.
Second, your vendors get spooked and might tighten your credit terms from net 60 to due on receipt, which completely cripples your cash flow.
And your competitors weaponize the rumor.
Absolutely they do. They will call your biggest accounts and say, hey, we hear John is selling out to a private equity firm. The quality is going to tank. You need to move your contracts to us to ensure stability. It is a self-fulfilling prophecy of destruction.
Which is exactly why Bata Commercial Group utilizes stealth marketing. We deploy blind profiles. We force highly restrictive non-disclosure agreements before a buyer ever learns the name or location of the asset. We ruthlessly financially qualify buyers to ensure they actually have the liquid capital and the operational pedigree to close the deal, insulating the seller from tire kickers and corporate espionage.
And we manage the emotional volatility. For an owner, selling their business is parting with their identity. It is highly emotional. By having Bata act as the aggressive intermediary handling the math, the negotiations, and the lender friction, the owner is shielded. They can focus solely on maintaining their revenue trajectory through closing, which is honestly the only way to ensure the deal actually funds.
The ultimate goal is not just to close a transaction. It is to maximize the capitalization of a life's work. If you are an owner listening to this deep dive, and you are even remotely curious about how the market would price your operation, or what structural changes you need to implement today to secure a premium multiple tomorrow, you have to start the conversation now. Preparation is leverage.
The most profitable conversation an owner will ever have is the one they have 3 years before they actually need to sell.
Exactly. Reach out to our team. Go to www.batacommercial.com. Once again, that is spelled B-A-A-T-A, www.batacommercial.com. Connect with one of our agents and let's start engineering your exit strategy.
As we wrap up this deep dive into the architecture of business valuation, I want to leave you with one final, highly provocative thought.
Yeah. We have spent the last hour breaking down SDE, EBITDA multiples, LBO mechanics, and DSCR ratios. But strip all the complex financial engineering away for a second and ask yourself a brutally honest question. If you had to step completely away from your business tomorrow, no emails, no emergency phone calls, no checking the operating account, and you couldn't return for 6 months, would the business still run?
Would it still grow?
Right. If the answer is no, you do not own a commercial asset yet. You own a very demanding, highly illiquid job, and the market pays a fraction of the price for a job than it does for a self-sustaining cash flow engine. Look at your operations tomorrow morning and figure out what you need to automate, delegate, or systematically replace to transform that job into a true generational legacy. If you found value in today's episode, make sure to subscribe and share it with someone who's serious about growing in commercial real estate. If you're looking to buy, sell, lease, or invest, or if you're a developer searching for your next opportunity, reach out directly. And if you're an agent ready to build your commercial business, let's connect. Until next time, go build your legacy.